Chapter 14 covers financial statement analysis. So in the examples for Chapter 14, we're going to look at actual financial information for Nike and Adidas. So this is information that I pulled off the internet about Nike's current financials and Adidas's current financial reports. As publicly traded company, they are legally required to provide information about their financial standing on the internet and to the SEC. So this information is publicly available. Most financial analysis data needs a minimum of 5 years of information to show good trend analysis. So when we're looking, we want to be looking at 5 to 10 years of financial information in order to see any trends in the data. We have 3 different types of financial statement analysis, which are the horizontal analysis or trend analysis, vertical analysis, which is also called a common size financial statement, and financial ratio analysis. So the first example that we're going to do is the trend analysis or horizontal analysis. So we'll just take this over to the side here. In trend analysis, we select a base year. This is generally the lowest year of our information. So in this, we're going to choose 2016 as our base year. What we're looking for is information as it relates to changes from the first year. So the first year is what we set as our 100% information. So in 2016, we would take 2016 revenues divided by 2016 revenues. So this would be our 100%. In 2017, we would take our 2017 revenues divided by our 2016 revenues because 2016 is our base year. We then take every year divided by our base year of 2016 to get this trend information or horizontal analysis information. So the 2019 revenues divided by the 2016 revenues and 2020 revenues divided by the 2016 revenues. We would want to look at all of our financial information as a whole. So because we're using Excel, we can now just copy all of those formulas down through both our income statement and our balance sheet and have all of this information. Then I like to go through and remove the information from blank lines so it's easier to read. Actually, we don't need these lines. We can clear the line that's the heading for the balance sheet and any lines that are just blank. Now we have trend analysis or horizontal analysis for 5 years for our income statement and our balance sheet. So we can look for anything that is trending or things outside of the trend. So when we look at their revenues, we can see that their revenues are growing fairly consistently, about 6% a year until we get to 2020. In that case, they've reduced. This, I don't think, will be uncommon with a lot of businesses for their 2020 data, given with the changes in COVID and other things. I think we're going to see a lot of revenue dips for 2020. Nike's fiscal year ends on May 31st. So their financial information that's been disclosed is also showing the first 5 months of 2020. With Adidas, they only have information public through the end of 2019 because their fiscal year is different than Nike's fiscal year. But I think when we see a lot of, especially retailers, information for 2020, that we're going to see drops in the amount of revenue. We would look at this information to see if there were anything that was really outlying. So in this, we can see that we have this huge and if we look over at the headings, this is income taxes. So in 2018, we had some changes. We had some things happening. So one of those things was we had some losses. 2018 is when Nike made their Colin Kaepernick announcement. So they had losses related to the backing of Colin Kaepernick. Their stock took about a 20% dip after that announcement. It has since rebounded, but there were some market repercussions for that announcement. Then we also have this 277% change in tax payments. So part of that, if you look up why Nike had so many income taxes in 2018, what you'll find is that there was a fraud investigation that they lost and they paid a whole bunch of fines because of that. So part of this is IRS fines from previous years. Now, if we look at the balance sheet and look for different outliers, so we can see here we have this 223% growth that is out of line with everything else. If you look over, that's other long-term assets. So not property, plant, and equipment or goodwill and intangible assets. These are other long-term assets. So this is another thing where we would have to go into their financial statements and look at where that investment was, whether they were purchasing long-term investments that they were holding onto for any reasons. Another thing that is big is this long-term debt. So we've gone from pretty consistent long-term debt in 3-year period to a 471% increase in long-term debt. So we can even see that financially here. We've tripled from the previous year and really grown our long-term debt from 2016. That could signify future cash flow issues for Nike because now they have all of these debt payments. So we also want to do horizontal or vertical analysis. That was our horizontal analysis. Now we want to do vertical analysis. Vertical analysis is also called common size financial statements. So we're going to do a common size income statement and a common size balance sheet. What this information shows, that's not the one I want, percentages. When we change the financial information to percentages, it is easier for us not only just to see trends in the financial information, but it's also easier for us to compare that information to other companies and to benchmarks. So we can see what is their percentage of net income to their gross profit or to their sales revenues, and not look at the different cash values because some companies are very differently sized than other companies, but might be within the same industry. So by looking at the percentage analysis, we remove that financial, the dollar signs from that information. In a common size statement, we look at everything in relation to a set amount. So for example, we look at everything vertically or up and down versus the trend where it's across. On an income statement, our 100% line is revenues. So in an income statement, we are looking at everything as it relates to revenues. On a balance sheet, it is everything to total assets. So our 100% line on an income statement is revenues or sales, and on a balance sheet, it is total assets. So we would take revenue for 2020, take our revenue divided by revenue. We're going to lock this cell by putting in the dollar signs. So now that that cell is locked, we can copy that formula. When we're in Excel, what I like to do is to copy it all the way over. And now we're just going to change that B to C. So here that B needs to be changed to a D, just saves time from going back and forth to the rows. Now we can select this row, change it to percent, and then drag our formulas down. And now we have a common size income statement for 5 years where we see everything as a percentage of sales revenues, and our sales revenues line in all years is 100%. So we can see that we have a trend here where in 2020 for every dollar in sales, we generated 67.9 cents in, no, 6 cents, 6 cents in net income. This is our gross profit. This will also be what the gross profit margin is. So if we were looking at financial ratio analysis, the gross profit margin is gross profit divided by revenues. And our net income ratio is net income divided by revenues. So we already have that information here, net income divided by revenues and gross profit divided by revenues. When we go to the income statement or to the balance sheet, remember that our 100% line is total assets. With the balance sheet, we use total assets as our 100%. So we'll take cash, which is the first line in the balance sheet, divided by total assets. We will lock that total assets cell so that we can copy and make it faster in Excel. So bring that over for 5 years, change it to a percent. Also going to, because I copied from a locked cell, I have to change that cell reference. So I'm making sure that we're getting the total assets in their year. So cash divided by total assets, and we carry that all the way down to the end of the balance sheet. Remove the blank lines. And now we can see the amount of items that we carry in relation to the total assets. So one of the things that we can look at now is as we're looking at, so we saw that debt ratio here in the horizontal. Now we can see that we have 30% of our long-term debt, so 30% to total assets in our long-term debt. We've also changed our debt to equity ratio. So before in 2016, we have equity of 57% and liabilities of 42.66%. Now we're at a debt to equity ratio of 75% debt or liabilities to 25% equity. So this can be concerning as companies finance themselves with more and more debt about their ability to pay off their financial obligations. When we look at a comparison, we generally want to look at benchmark information or comparison data. Adidas has smaller numbers than Nike, so about $10 million less in revenues than Nike does, but we can change that information to percentages and have a better idea of just industry to industry, competitor to competitor. So remember, in the horizontal, we look at everything to a base year. So we're going to divide everything by 2015. 2017 divided by 2015, 2018 divided by 2015, and 2019 divided by 2015. change that to percentages. And then because it is Excel, we can copy that all the way down. Move where we have the no lines or the years. So what we can see here is actually that we have fairly standard trends. So 13%, it's roughly actually 13% each year, 10% here, but 13% here. Then we would also look at the vertical analysis for this information. So remember in the vertical, on the income statement, we take everything as a percentage of sales. And on the balance sheet, it's everything as a percentage of total assets. And if we lock that cell, then we can copy our formulas. And we can see that we're fairly consistent. So we don't have the same kinds of ups and downs like Nike does, where they had a dip in 2018 and then a dip also in 2020. Of course, we don't have 2020 information here, but we don't see that kind of up and down here in Adidas's information. We just see fairly consistent growth. So for the balance sheet, remember we set everything divided by total assets. And we look at our information there with our 100% line being total assets. So here we can look at our debt to equity or total liabilities to total equity line. And we see that they have more of a 65 to 34 equity section. We're fairly consistent each year in our percentage of assets to total assets. We don't have huge jumps anywhere in inventory amounts that are concerning. We don't have big leaps in other assets. So, but the main one we have here, that's other long-term assets also, where we see a big jump. So some kind of investments, we'd need to go to their financial statements to read in the notes about where that income is coming from. But we see a lot more stability in their financial information from this ratio analysis than we see in Nike's financial information. So the third analysis that we do is financial ratio analysis. So some of the main financial ratios, and these are all in a list in your textbook on page 256. First, we have the current ratio. The current ratio is a liquidity ratio looking at our assets to our liabilities and our ability to pay them. So this is current assets divided by current liabilities. So total current assets divided by total current liabilities. And what we want that number to be higher than 1, and so it is consistently. Anything below 1, we would have higher current liabilities than our current assets, and it shows issues with our ability to pay off the debts that we have coming up. The next ratio is the asset test ratio, or the quick ratio. It's also called a quick asset ratio. This is just cash, cash equivalents, and accounts receivable divided by current liabilities. So we're removing inventory and prepaids, which can't be turned over as quickly as cash into cash. So we don't have cash equivalents, so cash plus receivables divided by total current liabilities. We would also prefer if this ratio was over 1. It is, so that shows that we don't have a lot of concerns about Nike's liquidity or ability to pay their short-term debt. Working capital is current assets minus current liabilities. So this is a dollar amount of the current ratio, where we're looking at current assets to current liabilities. So this is what we project to have in the next year available to do other things other than just pay debt. Accounts receivable turnover looks at how many times a year we turn over our accounts receivable. So how often we can collect on our accounts receivable. So this is calculated by taking sales or revenues divided by average accounts receivable. So average accounts receivable, if we're looking at 2020, would be 2020's accounts receivable plus 2019's accounts receivable divided by 2. So we're going to take 2020 receivables plus 2019 receivables and divide them by 2. And we're going to take that over. We do not have 2015's information that we would need to do that. So for 2016, we're just going to take the sales divided by accounts receivables. For days to collect, we take 365 days in a year divided by the accounts receivable turnover. This tells us on average how long it takes for a customer to give us cash for credit sales. What trends we're looking for in this information is if it's taking longer and longer and longer for us to collect cash from our customers, that can show liquidity issues or issues with having cash available to pay our customers. For inventory turnover, this is cost of goods sold divided by average inventory. So cost of goods sold divided by average inventory. So inventory from 2020 plus inventory from 2019 divided by 2. And in 2016, we would just want that divided by 2016's inventory since we don't have 2015 information. Days in inventory is similar to days in collectibles. We take 365 days divided by our inventory turnover, and this tells us that on average in our fiscal year 2020, each piece of our inventory sat on a shelf for 112 days before it was sold. Our debt ratio is total liabilities to total assets. Or 74%, which we already saw in our horizontal analysis. The gross profit ratio is our gross profit divided by revenues. This would also be similar to what we saw in the horizontal or the vertical statement information. Earnings per share is net income divided by the outstanding shares. So we have our net income and our shares outstanding. So the number of shares outstanding. So our earnings per share for each year. What earnings per share tells us is what the projected, it looks at the possibility of growth for a stock. It's the amount of earnings that could be shared among common stockholders. Our return on assets is operating income divided by average total assets. So this is operating income. Operating income is income before interest and taxes. So we need operating income. And if we don't have a line that says operating income, then we have to calculate it ourselves. In your homework, you're going to have to calculate it yourself. But operating income divided by average total assets. So remember that assets from 1 year plus the assets from another year divided by 2. And in this year, it would just be divided by that year because we don't have previous year's information. Return on equity is net income divided by average total equity. So net income divided by average total equity. So total shareholders' equity in 2020 plus shareholders' equity in 2019, and that divided by 2. And that is our financial statement analysis from chapter 14. There are also some references posted in my.Wartburg. And of course, if you have any questions, you can always email me. Next week, chapter